All right, so let's get started. Hello, Mohnish. Hello, everybody. I sent a short video of Mohnish, so I guess in the interest of having a very productive session, we can just dive in. Mohnish is a longtime friend and mentor, and we're both practitioners of the value investing philosophy. If you want to ask, submit a question, you can do it in writing on the Q&A section. And if anybody wants to open his microphone and camera later on, we can do that also. Mohnish, thanks for taking the time to share your thoughts with us.
Absolutely. It's a pleasure and honor to be here, Dante. And thank you for having me.
Wonderful. So this is your second time speaking to a group of Peruvians, actually. You remember 10 years ago, we came down here for our group meeting in Cusco. And so this is a very somewhat different context. We have a runoff election coming in a couple of weeks, and you have a group of very concerned Peruvians on the webinar here. So my first question would be, how would you process a potential, let's say, major negative structural change in your country? How would you face that?
Well, it's a great question, Dante, and I'm not sure if I can be of much help versus all of you with a lot more data. But what I would say is that things are never as bad or as good as they seem. And also humans have a tendency to project present circumstances to infinity. So things look uncertain and they will assume that'll go on. If we look at the recent history of Peru, we have seen a revolving door of leaders come and go. And another thing to keep in mind is weary is the head that wears the crown. And so whoever gets elected has to do certain things to win the election. Once they get elected, the focus of virtually all politicians globally would be to basically stay in power. So they would not be so much focused on, oh, I told the people X and therefore I have to do X. That's not how politicians process. Politicians are trying to survive. So even if, you've got, let's say a politician is completely honest or another one is dishonest. In both cases, they want to survive. And in both cases, they want to win re-election. And so therefore, they will focus on what is in their best interest to stay in power. And so when you process that, I think election time rhetoric may or may not come to pass. Also, I would say that in 2021, someone coming to power, especially in Peru, has the glaring example of Venezuela to look at, has the glaring example of the Soviet Union to look at, has a glaring example of China to look at. So there are lots and lots of examples available today, which maybe were not available a few decades ago. So I would say that I wouldn't be overly alarmed at this point, and I would not be trying to make irreversible changes. I would be careful about that. But I think if you do some hedging or hedge your bets, that may not be a bad idea.
Yeah, sure. Thank you. Yeah, this is a very complex issue, and I guess we'll just let's discuss investing, which is the main purpose of our call. So your approach had a major evolution last year, right? I'm referring to the nomad letters. Uh, can you share how and why have you changed your investing approach?
Yeah, so there's a book that came out recently, and it's called Richer, Wiser, Happier. I think there is a Spanish edition. I know the rights have been sold. I'm not sure the Spanish edition has been released yet, but I think it's a exceptionally well written book. A very gifted writer, and I would recommend the book highly, even though chapter one is on yours truly. But it's a great book. So about a year ago, I received a galley copy of the book, which is kind of a pre-release kind of transcript version, and um, and I read that galley copy, and chapter six um, of that of the book is was transformational for me. So chapter six is called Nick and Zach's Excellent Adventure, and uh, and it's about these two guys who ran the Nomad Investment Partnership in the UK from 2001 to 2014. And Nick Sleep, who's one of the two partners, I've known Nick for maybe close to 2 decades, and I'd meet him periodically in Omaha or in California and so on. But I hadn't really been in touch with him for a while, and so uh, I didn't realize he had been on this journey, and he had gone through a lot of evolution and growth over the years. And I think at the end of it, he had, for the most part, I would say, cracked the holy grail um, of investing pretty well. And so there were a number of lessons that I got from reading chapter six. So I reached out to Nick, and then Nick sent me all his Nomad letters, which I read, which now he has posted online. And I think maybe you could give everyone a link to that if you just Google it and such. So reading the letters and reading chapter six um, made me realize that uh, in many ways I was barking up the wrong tree, and and at the very core, um, all of us have been through this transition. Buffett went through this transition. Nick Sleep went through this transition, and I'm going through this transition, which is the transition from Graham to Munger, and Nick might argue beyond Munger. So it's a move from buying discounted pies um, to buying growing pies, and so if you buy discounted pies, so if you buy a dollar bill for 50 cents or 40 cents, generally good things will happen to you. Eventually those valuation gaps will converge, and if that conversion happens in 2 or 3 years, you'll have a pretty healthy rate of return, even with some errors and such thrown in. Um, but growing pies, especially pies that have got strong tailwinds, almost always will trump discounted pies. And in my own experience, I have left a lot of money on the table by selling growing pies too early. So the key is to so there's a shift in framework when you go from discounted pies to growing pies. Um, when I was buying discounted pies, I fixated on intrinsic value. So I said, okay, the business is available for $200 million market cap. It's worth 400 million, and when it's worth more than 350 or 375 million, I will sell it. Capture most of that gap. Um, with the Nick Sleep uh, growing pies model, you wouldn't necessarily sell a business just because it was optically somewhat overvalued. So, in the case of this 200 million market cap, it may not be a candidate for sale, even if the market cap went to 450 million, for example. But the idea would be that when you're buying these businesses, you'd be looking for businesses which have strong growth ahead, strong returns on equity, great managements, and all of those things. And then basically the framework is to think of it the way an owner or founder of the business thinks about it. So you don't think of yourself as a investor in the business. You think of yourself as a co-owner or a co-partner in that business. And the other thing about the Nick Sleep model is basically basically for the most part, when I look at Nick's 14-year journey, he was very right on one bet. And that's all you need to be right on. So he applied his frameworks to a number of companies and positions, and a number of them did quite well, but one was an outlier, and that made all the difference. So the other side is that when you give these companies room to run and time to run, even though you're not doing kind of venture investing, you may not need all of them to do spectacularly well for the portfolio to do spectacularly well. So in the case of Nick and Zach, they understood relatively early that Amazon was a very unusual business and it had some unusual traits. And it had this notion of what they call scale economy shared, where as the business grows, the business is sharing more and more of the spoils of the scale with its customers. Costco does the same thing, where as Costco grows, it gives it back to the customers, and Geico does the same thing. And I'm sure there are examples in Peru of businesses which take that approach. Most businesses, when they scale, like let's say if I look at a business like MasterCard or American Express, when these businesses scale, they get economies of scale and operating leverage, but they keep it for themselves, which is what most businesses do. But some businesses, basically like business like Amazon, does not focus on how much money they can make today. They focus on how much money can I make over time from this relationship, and how do I maximize that? So they understood Amazon really early. They were willing to concentrate their assets into some of these businesses that they thought were very remarkable. And I think in 2014, when they shut down, Amazon might have been about a third of their assets. It may have been a pretty significant part of the pie. And they were getting grief from the UK regulators about the degree of concentration. So the two of them just looked at each other and said, we've made more money for ourselves than we ever thought we would. They were running about 3 billion at the time. I think they each probably were worth around 100 million or more. And so they returned all the money, shut down the funds. And in the case of Nick Sleep, he put his 100 million into 3 stocks, Amazon, Costco, and Berkshire. And today, in the middle when Amazon went up a lot, he added a 4th stock, sold half the Amazon position, but that's also gone up. So the bottom line is that even after shutting down the funds with very little activity, Nick and Zach have beaten most professional managers without doing much to the portfolio or anything. So I think that as entrepreneurs, we know this. We can start with an embryonic idea, nurture it and scale it, and it can lead to tremendous satisfaction and wealth creation. And that's the same framework one should use in these portfolio positions. So just because the stock market allows you to sell anything in 2 minutes, doesn't mean that that's an advantage.
Yeah. So on that point, doesn't it make it like more difficult to, reach a conviction level regarding the durability of the moat? Because you'll need probably a very deep and lasting competitive advantage. So if you look at the S&P 500, I think like half of the members today were not there 20 years ago, because that's the nature of capitalism. So how do you deal with that in terms of getting the conviction to commit to a long term holding?
Well, I think there's a couple of ways to do that. One is that you could start with a smaller position size. So I always feel that you only learn about a business after you own it. So you may do work on it, you may analyze it, you may think you understand it, but I think the degree of competence in the business and understanding of the business is only going to grow over time as you look at it as an owner. So uh, the familiarity and competence in a business will increase over time, and you could start with a smaller position and let it, you know, bump up in size as your understanding grows. Um, I usually don't do that. I usually, if I make a bet, it's 10% of assets, and and so we can't make many bets because there's limited slots in the portfolio. So a lot of things just get filtered out because we've got opportunity cost issues with different things. So creative destruction in capitalism is very real, and most businesses will not even last 10 years or 20 years or 30 years. So clearly there is an art and a science. Um, I think what Nick and Zach did is they asked themselves three questions um, about the business before they invested, and they probably continue to ask these questions as they owned it. The first question is, what is the destination? So if you look at a business and you ask yourself, okay, what does this business look like 10 years or 20 years from now? And just try to get some idea of what you think might be the range of outcomes over that period of time. So that's the first question. The second question to ask is the business getting better? Is the moat getting deeper? Is the moat getting wider? Are the economics getting better? So as you own the business, you would ask yourself, uh, you know, so if you had a business, let's say we were looking at a business like Costco. Uh, each time Costco opens a new store, its moat gets deeper and wider because the members have one more store that they can go to. So it makes the entire network more valuable, and new members join that particular store, or they join the Costco network because now there's a new store. So the scale economics of buying become even stronger because Costco can now buy more detergent and more wine and more cheese and pass on those benefits. So each time a new member joins Costco, or each time Costco opens a new store, the business gets better in general. Costco recently entered China. So they just opened their first store in China, and it got mobbed. They had so many people, they couldn't let them in. So if you do destination analysis for Costco, looking 10 years or 20 years out, today there's nothing that we can see which shows a business in decline. We don't see any issues in Costco that are visible that show a business in decline. In fact, it shows a business whose moat is getting wider and stronger. So it is possible that in 10 or 20 years, there's 1,000 or 2,000 stores in China. It's also possible China could fail. We don't know. It's a range of outcomes. Um, and so this is how you would think about it. And the third question you would ask yourself is the valuation reasonable? So not that is it undervalued or fairly valued. So the only time we would act is if the valuation got egregious. So let's say, for example, a business like Costco is usually trading at 30, 40 times earnings, trailing earnings. if Costco got to 100 times earnings or 150 times earnings, uh, probably should be sold, assuming those are normalized earnings, because it's egregiously overpriced at that point. So I think these are the main questions to focus on with the compounders. And the creative destruction of capitalism would lead you to a negative answer on, is the business getting better? So if a company is facing headwinds and the kind of moat has shifted or reduced, uh, it would eventually show up in the answers to those questions. And if the business is no longer getting better, so you have to separate noise from secular. And if it's on a secular decline, you absolutely need to get off that bus.
Yeah, yeah, yeah. So, I mean, running a fairly concentrated portfolio, you need to have a real alignment with your LPs, right? With your investors, because of course you need to accept higher volatility, which, as we know, it's not risk. How do you deal with that, with the higher volatility in terms of the consequences on your investors?
Yeah, so I think at Pabrai funds, almost all of the money is non-institutional. Pabrai funds has around 600 million, and most of it is high net worth individuals and families, and most of it is first generation wealth, which is an entrepreneur who's basically created their own wealth or success from their business. Um, so we have around close to 400 families around the world who have invested with us. And I like that group. The group is a relatively patient group. And we've had plenty of volatility in our results. If I look at the 22-year history of Pabrai funds, we've had at least 8 years where we've had significant declines. We've had two periods of 3 years when we had big declines, and one period of about 2 years where we had big declines. In fact, like in the financial crisis, the funds were down about two-thirds. Um, and so, I mean, I think I've tried to explain to our investors that we will continue to have volatility. It's just the nature of the way markets work and the way businesses get valued. And yeah, so every year we do have some redemptions. People redeem money for many reasons, but we also have subscriptions of people coming in. So it's been quite manageable.
Yeah, yeah. So we have a few young investors on the call. What do you think are the key, let's call it individual traits and skills that you need to have a successful investing career?
Well, I would say first, the first most important skill is extreme patience. So if you are the kind of person who loves to watch paint dry, then this is the profession for you. If you are a guy who needs a lot of action, then this is pretty ill-suited. So patience is a trait that needs to be built in uh, to the person. Uh, I think once you get past the patience, then there are just some basic things, which is one is that Buffett says that I'm a better businessman because I'm an investor, and I'm a better investor because I'm a businessman. So if you have had significant prior experience running a business, meeting payroll, getting bankers to back you, all those things, uh, that is worth many MBAs, and it's very valuable if you're running a business. Like Buffett said, I think, um, how could you explain to a fish what it is like to walk on land? One day walking on land is equal to 1,000 years talking to a fish about it. And it's the same thing about a business. One day running a business is more valuable than, reading and learning about different businesses. So Uh, Real experience is important. When you're actually making investments, I think the most important thing there is circular competence. So you want to make sure that you believe that the business that you are looking at is one that is squarely in the center of your circle of competence. And most businesses, I would say something like 90 plus percent, 95, 99% of businesses would be outside my circle of competence. Entire industries are outside my circle of competence. And so you need to be a harsh grader and get rid of businesses that fall even at the edges of the circle. But once you have the
Yeah.
patience and the circle of competence, then beyond that, I think you're just looking at businesses you understand well. If they're within your circle of competence, by definition, you know what they're worth, and then you're looking to understand the destination and understand the likelihood of that destination, and then make a bet if it makes sense.
Yeah. I also think that we don't learn anything from successes, right? When you have a good investment, and in many ways, probably success is determined by how we deal with failures. And so, can you discuss how to deal with failures and criticism? Because that comes with it.
Yeah, I mean, I think I'm a big fan of Marcus Aurelius and his Stoic theory, Stoicism, and so Marcus Aurelius was a Roman emperor. He shows up at the beginning of the movie Gladiator. The old king who is dying, uh, with Russell Crowe as his main general. So the old king is Marcus Aurelius in that movie, and he spent almost his whole life on the battlefield. He had a lot of injuries. He had a lot of illnesses, and he faced a lot of suffering throughout his life. And Marcus Aurelius says that um, to encounter suffering or misfortune and to overcome it is actually good fortune. So you grow out of uh, the misfortunes that hit us. So success is a very bad teacher. We don't learn anything when we do well on something. We do learn a lot when we stumble and fall and pick ourselves up. So I think that in business and in life and in investing, um, the stumbles is what helps us grow and learn. And so we should be very thankful and grateful for the stumbles. It is the investments that don't work out or don't work out so well that are our greatest teachers.
Yeah, I agree 100%. So, changing gears now, how would you overlay? I mean, we are micro investors, no? We have to put up with a macro. And how do you overlay a macro framework in your analysis? In particular, I mean, right now, inflation, persistent inflation might show its ugly face, no? We know that. And how would you assess and prepare for it?
Yeah, I think macro factors are really hard to figure out. It's hard to figure out. I mean, just like the question you asked on Peru with the elections and what Peru looks like 6 months from now. Um, we can make all kinds of you know assumptions and assertions, but many of them will be proven wrong, and such. So uh, figuring out what's going to happen on a macro level is difficult even from the best economists and such. And to a large extent, I think it's a fool's errand. So I think the attention should be on the micro, the attention should be on the business. So again, if we go back to a business like Costco, whether we have inflation or not may have some impact on Costco's business, but it probably should not have much bearing on whether we invest in Costco or not. Whether we invest in Costco or not has a lot more to do with the moat and the valuation, not so much what's going to be US unemployment next year and what's going to be inflation and those sorts of things. I mean, those will have an impact, but they're very unpredictable. So
Yeah, yeah,
don't fixate. Um, it's very difficult to figure out what will happen with inflation or unemployment or the economy or exchange rates or who's going to be in power. All these things are very difficult to figure out.
yeah, I agree. Um, so Warren says that his partner, Charlie Munger, which of course we know well, you know him much better than me, he has the best 30 seconds mind in the world, right? And that also he's known as the abominable no man, and the grandmaster on the stupidity reduction. Um, what key lessons can you share that you have got from Charlie? And but most importantly, how do you make it your own? No, because one thing is to learn something, but the other thing is to, internalize it.
I've been actually thinking about this very question for the last few days, and I'm bothered by it, and I'm trying to find the answer. So, one of the, I would say, one of the biggest takeaways I've gotten from my friendship with Charlie has been watching him in his home and watching how he is set up in his home. So I've been fortunate. I think probably every 3-4 months I get invited for dinner with Charlie, which is wonderful. I have to pinch myself at his home, and uh, the best way I can describe it is that Charlie, he's not very mobile anymore. He needs help to. I mean, he needs to use a walker to move around. He's still pretty independent, but golf went away a few years ago. Now playing bridge at the club has gone away. So more and more things related to his mobility are going away. But even going back maybe 10 years, looking back, uh, Charlie has this very comfortable lazy boy type chair that he sits on at home for most of the day. He sits on that chair. And that chair is in the middle of what I call an assembly line. So there are stacks of books and reading on both sides of the chair. And this assembly line, which is Charlie's reading and brain, is plowing through these at an incredible rate. And he has just one eye, and that eye is not that great, and he needs very powerful lights. So he's got two very powerful, uh, you know, uh, floodlights throwing light on whatever he's reading. But I think of it metaphorically almost like this assembly line of books and reading that is going through his brain and out the other end. And the speed and veracity and velocity by which it is going through, um, I feel when I look at that, I look at how I am reading and looking at my time, it pales in comparison. I mean, so Charlie has never used a mobile phone in his life. He has never used a laptop or desktop computer in his life. And I wish I was like that because so much of our time gets wasted on silly little Apple devices. And so he has no time which is going on the web or going on Facebook or looking at email or any of that. All that is going on all the time is just two things. The assembly line is cranking, and once in a while he's talking to someone on the phone, and sometimes he's meeting some people in person. And whenever I go to see him, sometimes I take some books for him. And when I bring those books next to him, I see a glitter in the eye, which is like a 5-year-old kid who's about to get some great candy. Like his eyes light up when I show him some new books. And then I see that his excitement level goes down because he look at the first book and say, yeah, I've read this one. Okay, you can take it back, Mohnish. Look at the second one. Oh yeah, I've read this one. You can take it. And then the third one is one he hasn't seen before. Oh, this is great. Thank you very much. And he puts it into the assembly line. Okay. And I know it's going to be devoured in and out in no time. Okay. So he's got value line within reach of him. He's got a bunch of reports and printouts that he gets, probably warrants and stuff, and things that his assistant is printing out for him. And he's got all this different books. And almost every time I go meet him, there's one or two books that are high on his mind that he's been reading, and we'll talk about like I think one time he was reading a book on the chief of staff of President Franklin Roosevelt, and I think it was Admiral Leahy. I think that was the guy who was the chief of staff, and Roosevelt really trusted Leahy. Roosevelt trusted almost nobody, but he trusted Leahy. He was one of the only guys he trusted. And in World War II, he was making a lot of unusual decisions, which in the end had a great outcome. But for the most part, it was just him and Leahy. And so this was a book on Leahy. And Munger was basically saying, Leahy is this kind of guy that you would love to go drinking with. He's kind of a very friendly kind of guy. But the key thing that he had was that he had Roosevelt's trust, and that made him very effective. And so, the topics and things we talk about. Another time, I went to see him. We were talking about sand. So we spent about half an hour talking about sand, and we were talking about sand because he's building these very large dorms for the University of California at Santa Barbara, where he's donating money, and it's going to be some of the largest dorms ever built for any university, and it'll transform the housing situation. And the thing is that there is a erosion issue because it's near the ocean, and there's an erosion with the sand and all of that, and so Charlie was going into how there is a wide range of sands. And, for example, we get some sand from Wisconsin that is really good for fracking. So they actually transport it from Wisconsin to Texas, for example. And it's the sand that's used for, fracking the rock and so on. And sand is actually in most places, it's fossils. So if you look at your Peruvian beaches and you look at that beautiful sand, those are all the skeletons of creatures in the past, for the most part. That's where the origins of sand are. And therefore the texture changes a lot depending on what type of life and what type of creatures were pounded into that shape. So what I'm saying is the subjects go all over the place. Another time I had a discussion with him on how to design parking lots. He was designing this parking lot and he was stuck on something. So he's asking me, what is the height of a F-150 truck? And hell if I knew, but Google knew, so I told him, and so on. So the discussion goes all over the place.
Yeah, Charlie is amazing. And of course, the whole concept of the lattice work of mental models, that we need to bring, which is quite useful in investing, but in general, in life. Now, in 1955, Ben Graham, the father of value investing, declared, it was a Senate hearing, I think, that the market looks high, and it is high, but not as high as it looks. What is your general sense today of U.S. equities market?
Well, I would say that in a relatively small sliver of the market, it is clearly in bubble territory. Um, but it's not widespread. I mean, I would say that the Fed was asked recently about Bitcoin, and they said, yeah, there's probably a bubble in Bitcoin, but we're not concerned about it. And the reason they're not concerned about it is because the entire asset is not worth that much. That entire asset base is not it's not like the, I mean, when you talk about the value of US residential housing, you know, that's tens of trillions of dollars.
Yeah.
It's a very significant portion of the total wealth or assets in the US. When you talk about something like Bitcoin, it is a pimple on a camel's butt from the Fed's perspective. They do not care about that pimple. At some point, that pimple might burst, but it's irrelevant. So we do have, there's a really good book I liked, which I read a while back. It's called Trend Watching, and it's written by Ron Insana. He used to be a CNBC anchor. Normally, anchors are useless authors, but Ron actually did a good job, and the whole book is about bubbles, and he chronicles, hundreds of bubbles. And when you read that book, you come to realize that bubbles are happening all the time. Uh, Somewhere in some part of the world, some asset class is overheated. It is in the nature of humans to vacillate from fear to greed and back and forth. So that gets manifested in different asset prices, where things get excessively euphoric at times, and things get pessimistic. So it is likely a business like Tesla is in bubble territory. It is likely Bitcoin is in bubble territory, and it is likely GameStop is in bubble territory. Okay, um, but and even in these three, I mean, I would say I would probably have the highest degree of conviction that GameStop is in bubble territory. The Bitcoin and Tesla, my conviction levels would be lower than it would be on GameStop. So I may be wrong. I mean, the good thing about investing is that I don't need to be right on Bitcoin, and I don't need to be right on Tesla or on GameStop if I have no bet. So I have no long bet in these places, and I have no short bet in these names. So we will always have bubbles, but it is not clear to me that we have a bubble in Microsoft or Salesforce or Amazon or any of the large techs and such. They may be fully priced. They may even be overpriced. But that's a much harder call in terms of whether they're overpriced or not versus GameStop. It's more clear to me that GameStop is probably in bubble territory. So I think we don't need to sweat it, because bubbles happen all the time in all kinds of places. People get euphoric and bubbles get formed. I mean, like if you look at a business like Snowflake, um, there are customers of Snowflake who swear by it, and they say they can't imagine life without Snowflake. So it is entirely possible that Snowflake may be undervalued. We don't know, but it's outside my circle of competence. So I just watch the show with my buttered popcorn and keep myself entertained on the sidelines.
Yeah, that's right. So we both run one-man shows, basically, right? With concentrated portfolios. You and I. For some financial advisors, that's like a red flag. No, they say you're too concentrated, too dependent on you. How do you explain the setup of this way of working?
Well, I would say that it's probably not going to appeal to lots of people. So, one of the issues is that rich people like work done for them. They don't like to do the work themselves, most rich people. They're used to delegating. And when some rich person invests in Pabrai funds, they are forced to do the work themselves because they have to figure out whether it makes sense or not, and then they have to figure out whether they want to invest or not. So the people I end up with, and probably you end up with, in our funds, are the anomalies. These are individuals who are, let's say, nerds about investing, and they are curious and they want to figure it out, and they spend the time to try to understand who can be a good custodian for their assets, and then they proceed. So they are typically not the ones who are listening to professional planners and so on. For most people, I think, who are not interested in doing that, rich people who are not interested in doing that, better than going to the helpers is to just index. So I think indexing is a great way to go. Um, Also, I think Omaha Capital is a great way to go, especially if there are uncertainties in Peru. I think your portfolio is all a non-Peru portfolio. So that can be a good way for local Lima residents to invest in a local Lima manager and not have the assets in Lima. A pretty good combination.
Yeah, well, I couldn't agree more. So, so let me ask you a couple of questions on Dakshan, your wonderful work you're doing in India, in philanthropy, and then we can probably open up for a few questions from the people. Uh, do you think philanthropy is genetic or is it like learned?
um, I think it can be both. So I think if a child grows up in an environment where the parents or grandparents are very focused on philanthropy and they get a lot of lessons as they grow up and they watch it as they grow up, they're going to have a certain perspective on it, which is going to be different from someone who didn't grow up with that. So certainly some parts of it can come through your natural experience in your formative years. Um, I think that um for most of us, and for me, for example, if you really spend any time thinking about it, you would come to the conclusion that you don't have a choice. So if you are successful enough where the assets you have accumulated exceed what you can consume in a lifetime, then you only really have two choices of what to do with those assets because we all are going to go away one day. You can either recycle it back to society in some way, or you can give it to your gene pool. So those are the only two choices. And there are negatives with giving it to your gene pool. So um, very large inheritances are a disservice to our kids and grandkids. We enjoyed our journey because we got to do it from scratch. And it was a great journey because of that. But I think that Buffett says that if you are Jesse Owens' son, the sprinter, Jesse Owens,
Yeah.
you will not become a great sprinter by starting 100-meter dashes at the 40-meter mark just because you're Jesse Owens' son, right? So you're going to be a useless sprinter. So he says it's okay to put Jesse Owens' son at the 5-meter mark or maybe the 10-meter mark, but not at the 40-meter mark. So you can give your kids some head start in life, but not give them an IV drip for the rest of their lives, a trust fund where they need to do nothing. I think that would lead to a wasted life. So for example, Bill Gates has been in the news lately for not so great reasons. But he and Melinda had decided that the kids would get $10 million each. So their entire fortune, which is north of 100 billion, only $30 million of that is going to the three kids so far that we know about. And because he wanted to give his kids enough money so they can do anything they want, but not enough to do nothing. Give them something where they want to start a business or buy a nice house or whatever else they want to do, they can do that. But uh, they need to do something else beyond that. And so I think for me it was the latter, which is I realized that just giving to the gene pool is going to be a negative, so I had no choice. I had to figure out something, and I'm a competitive guy. I didn't want to write a check to the Red Cross and be done with it. I thought I could do better than that. So that's why Dakshina got for.
Yeah, you're doing great, man. Um, let me read a couple of questions here. Your thoughts on investing in China, in a China ETF, actually. Um, I don't know, or also or in energy sector. These are very wide uh, sectors investment.
Yeah. So what I would say is that I think a better way to invest would be to look at. I mean, this is leaning towards index investing a little bit.
Yeah,
Uh, but I would say in terms of selection of indices, the US S&P 500 is a good one to consider. Um, you know, Morgan MSCI Global Index is a good one to consider. I don't know whether I would want to do a sector ETF or a sector bet like energy or a country bet like China. I don't know whether I'd want to do that. So I'd say this go with a more basic, broad-based index, and then dollar cost average into it as your earnings come in.
yeah. Uh, if anybody wants to ask a question directly, can open the mic. We have like a few minutes to go. In the meantime, I have another question here. In terms of your investment principles and main key elements you look at when you're analyzing an investment or an investment change. We're going through a structural change in society, geopolitics, climate, tech, DNA, whatever. As this has happened many times, paradigms changes in the last 100 years. In your view, which and which chain and which remain, which investments might be changed? I guess that's the question. I
Well,
don't
yeah,
know if you.
I agree that, uh, and especially with COVID, many changes that we would have undergone in our lives got accelerated. So our lives are becoming a lot more digital than they used to be even a year or two ago. And also, how we work and where we work is also going through significant change. So there are a lot of habit and behavior changes taking place. So I would just say that if you look at, like, for example, just let's say look at one area, which is, let's say, food delivery. Um, so we have seen the emergence of a number of large food delivery players, DoorDash, Uber Eats, and others around the world. Um, the That business is today relatively inefficient. One driver goes to one restaurant, picks up one order, and drops it to one customer. Uh, but that whole chain is going through a significant amount of rework. So we have these cloud kitchens that are being formed in warehouses where the rent is a lot lower than some high street restaurant. So they take the rent down. The staffing is completely different because it's only food prep. And they can also probably combine these restaurants in terms of buying power on the buying end, and maybe they could even combine some of the food prep. So there's a lot of back end stuff that could, in the long run, be a lot more efficient. And then on the other side, what is happening with humans is we are expanding quite significantly um, our interest and willingness to have all kinds of food delivered to us. That's going through. So when I look back, when I first came to the United States in 1983, I was in a town, South Carolina, Clemson. Clemson had one Pizza Hut. And at that time, Pizza Hut did not do delivery. It was a full service dine in restaurant with waitresses and everything. And, and a couple of years after I was there, Pizza Hut had started to experiment with delivery in about 10 or 20 locations. And over time, from the 80s to 90s to 2000s, that exploded. It just took off in a major way. And for the longest time, the only food you could get delivered in the US was pizza. There was nothing else that you could really get delivered 10 years ago, for example. It was just pizza. And all these pizza chains completely reconfigured to become very efficient. Like you couldn't go, if I went to a Domino's, they don't even have a table to sit and eat. You know, it was purely a assembly line to crank out pizzas very quickly, and a driver leaves with 5 or 10 pizzas, delivers them, and that whole supply chain became very efficient. Now we look at it today, and we've gone well beyond pizza. We've gone to almost, you know, even beyond any restaurant. You can get stuff delivered. You could get an iPhone delivered, anything you want. So I think that reconfiguration and those habit changes, for example, um, will lead to a bunch of winners. Now, the thing is that when you look at a business like DoorDash, for example, 50, 60 billion market cap, a lot of it is priced in. You know, I mean, there's a lot of assumptions being made about who the winners will be and so on. But this is an example. So the reconfiguration that we are seeing in our lives is real, and it will lead to a lot of winners and such. But I think that from an investing point of view, we want to invest when it's a total no-brainer. So yes, I know that food delivery is going to take off in a big way. No, I don't know how to use that knowledge to make an investment that makes sense to me. And that's okay. So you keep watching, observing, and once in a while, 7 moons line up and you can make an investment.
Yeah, that's right. Do you think that the pandemic will have like long-term consequences in the way we live, the way we work? What is your general take on that?
Yeah, I mean, I think COVID is here to stay. So COVID is not going anywhere. My guess is that we will be taking maybe 1 or 2 shots a year, all of us, in terms of vaccine. Maybe it gets integrated with the flu vaccine. We'll see. But COVID is going to stay with us, and but I think we will, as a species, learn how to make it a very muted fatality rate and muted in terms of serious illness and such. So, man is a clever animal, and so he's going to figure that out. Um, but I think COVID has permanently changed many things. It's shown us how work can be done very differently than we thought it could be done. It's shown us that many types of travel that we were doing aren't really that necessary, business travel and such. I mean, a good bit of it is, but a good bit of it, you can just get things done more efficiently. And so yeah, the impact of COVID in terms of long-term behavior change is quite significant.
Yeah, yeah. Great. Thank you, Mohnish. So can you show the book again to the camera?
There are multiple books. One is this book, which is great.
Yeah.
Richer, Wiser, Happier, which is great.
I just want to say that most people on the call do not need to buy it, because that's the one they'll get from me in a few months.
Okay. And then the other one, which I really like, which I read last year, was written by Thomas Phelps, 100 to 1 in the stock market. This book was written 49 years ago. And so it was published in 1972. But this guy is a very gifted writer, and he did an exceptional job. So both are
Yeah.
great.
Yeah. Well, and Psychology of Money also, no, right? That's a great book as
Psychology of
well,
Money
right?
also is very good. Yes.
Yeah. Yeah. So wonderful, Monish. I think we've got a very productive hour with everybody here, and I thank you for that. So
Thank you, Dante. It's a lot of fun, and hope you guys enjoyed it. And all the best. And I'm going to be watching what happens with the Peruvian elections. All the best.
cross your fingers. Thank you.
Okay. All right. Thank you.
Bye.
Right.
Bye.
Bye.